Hi, this is Bennett Tchaikovsky, and welcome to Accounting After Dark, where we go through and do problems which the publishers forbid me to do, but I'm doing this on an unlisted basis, so I guess it's safe for me to do. But in any event, this video is for you. So this is KESO problem 1812. I've been making way too many videos recently. So here we've got, this is relating to a franchise, basically a franchise operation. So here we have Amigos Burrito. Sells franchises to independent operators throughout the northwestern part of the U.S. The contract with the franchisee includes the following provisions. Okay, so they're charged an initial fee of $120,000. Of this amount, $20,000 is payable when the agreement is signed, and a $100,000 zero interest-bearing note is payable with a $20,000 payment at each of the end of the 5 subsequent years. The present value of an ordinary annuity of 5 annual receipts of $20,000. Each discounted at 10% is $75,816. And I'm going to go through in terms of how they came up with that number, because I don't want to just give you a number and say, oh, here's what it is. It's more important to actually see how that works. And that'll be a good review of present value for us. So all the initial franchise fee collected by Amigos is to be refunded, and the remaining obligation canceled if for any reason the franchisee fails to open up his or her franchise. So then over here, in return for the initial franchise fee, Amigos agrees to assist the franchisee. And here we go to these different ones. In addition to the initial franchisee, they're required to pay Amigos a monthly fee of 2% for the menu planning. And of course, you've got management, estimates of the fair value of services to be rendered at the franchise at the time of the contract signed amounts to at least $20,000. All franchisees to date have opened at their locations at the scheduled time. None have defaulted on any of the notes receivable. The credit ratings of all franchise would entitle them to borrow at the current interest rate of 10%. So right over here, before we get to this, and it's going to ask us to discuss the alternatives that Amigos Burritos might use to account for the franchise fees. And just to kind of look at this right here, and just so we know what exactly is a franchise. You have two parties. The franchisor is the one that owns the intellectual property rights. So it would be like, what is it called? Like doctors' associates that basically licenses out a franchise, a Subway franchise. And then you have the franchisee, who is essentially, basically the franchisor has a business model. They're giving it to the franchisee and a right to operate the franchisor's business, usually within a specified territory or location. And the franchisee, in exchange for that right to operate, is giving the franchisor cash as that initial fee. They may also be purchasing the items from the franchisor. And, you know, this right here is just, it can be a great business model. I've known of people who have bought Subway stores. They've done extremely well with them. And this is a while back, but at the time they did really, really well with them. Now I have no idea. But if a company is looking to expand a business or expand a product, the franchise can actually be a really, really good way to go. And, you know, when you look at this way, how is the franchisor going to make money? Well, they're going to charge an initial fee to operate the franchise. And then at the same time, they're going to require the franchisee to buy all their materials from them. So when they do that, they're going to be making a markup on that product. They can also be taking an overall fee of the total sales. And this here is right here is at 2% for this particular question. So, but at the same time, the franchisor, they want to maintain the value and build the brand. If you have bad franchisees, that may not work out. One of the kinds of things that we can kind of see, the other example would be with In-N-Out. In-N-Out Burger does not franchise their stores. They're all company owned and operated, and they're really about maintaining that quality. And one of the challenges is if you get a bad franchisee, that could potentially destroy your franchise. So again, especially in our day and age today, where one bad thing can essentially ruin you, that's something that could be a huge problem. So when we have the franchisor and the franchisee, we have these 5 different items. We need to go through in terms of general revenue recognition, We have to identify the agreement, identify the performance obligations, what is the consideration that's being paid, and then we need to allocate the performance obligations to the transaction price, and then we need to recognize the revenue as the performance obligations are satisfied. So let's take a look at the question over here. So to discuss the alternatives that Amigos Burritos Inc. might use to account for the franchise fees. Okay, so when we're looking at this franchise fee, it's like in terms of, okay, here are the fees of $120,000. When do we recognize it? Well, management says, oh, the value of the services rendered to the franchise at the time the contract is signed amounts to at least $20,000. There is one problem, though, with management's assertion, is that the assertion is directly contradicted by this language up here, which says, oh, all the initial franchise fee collected by Amigos is to be refunded and the remaining obligation canceled if for any reason the franchise fee is going to transfer that the franchisee fails to open his or her franchise. So, and this is going to be a no-go, because even though management says that they want to do it, there is language in this agreement that essentially prevents them from doing it. So in my opinion, in this case right here, even if there is a history, I would say you don't recognize anything until you actually open up the location. And again, that's because it's in the contract. As an accountant, we have to be very, very careful with revenue recognition. Why? It is a hot topic always with the SEC. That is not the Southeastern Conference, that is the Securities and Exchange Commission, right? We don't want to lose our CPA license, not worth it, right? So what we're gonna do is we're gonna basically look at the contractual language and we're gonna say, okay, well, that initial franchise fee, we should be able to recognize that once the store opens. So then what really happens here is that when should we be going through? So that's the initial $20,000, but what about this other $100,000? Well, as we're going to see in a moment, there's a problem here with this $100,000. It's a zero interest bearing note. And you know, with five $20,000 payments. So it's $20,000 initially, and then every single year they're going to be paying me 20 grand per year. So what we need to kind of go through and do here is kind of figure out, well, I know I can recognize the $20,000 when the agreement, when the franchise is opened. However, what about the ongoing amounts? And this is where it gets very, very subjective. So when I look at this right here, let's look at what our obligations are. In return for the initial franchise fee, this initial fee here of $120,000, Amigos agrees to assist in the selecting of the location for the business. Right, this is very important for the franchisor, because if they have something around the corner, might be a problem. Negotiate the lease for the land. Okay, this will be done on behalf of the franchisee. And again, this is going to be a one-time deal, because once that land lease is negotiated, they're going to be off and running. Obtain financing and assist with the building design. And again, this is a one-time deal because the franchisor wants to kind of control the way that that building looks. And also over here is supervised construction and establish accounting and tax records. These are all initial different types of items that really happened at the very outset of this particular agreement. And the reason why it's important to look at this is because this is really going to be dictating when do we go through, and we kind of know with this 20,000 that we could probably recognize it when it opens, right? Because we could probably kind of say that part here, but this last part here is provide expert advice over a 5-year period relating to such matters as employee and management training, quality control and promotion. This continuing involvement by Amigos helps maintain the brand value of the franchise. So when I look at this language right here, this might really kind of be saying to me that when it comes to these ongoing $20,000 payments, that I may want to wait to recognize these until I actually go through and actually, when they actually have opened and every year I'm being paid for it. So again, it's providing expert advice over a 5-year period, which is really that $100,000 are giving me 5 $20,000 payments at the end of each of the 5 subsequent years. So, and then over here, in addition to the franchise fee, the franchisee is required to pay Amigos a monthly fee of 2% from sales of menu planning, recipe innovations, and the privilege of purchasing ingredients. Wow, what a privilege. From Amigos are at or below prevailing market prices. So again, right here, right, this is, okay, I'm probably going to be recognizing this 2% once the sales are generated. And recipe innovations and everything else like that going here at or below prevailing market prices. Well, it's something I should be giving to them anyways, because again, I want to make sure that all of my customers, even though I do not own even though the franchisee is operating my business, I want to make sure that all of my customers have that consistent experience. So a couple other things of information here is that the credit ratings of all franchisees would entitle them to borrow at the current interest rate of 10%, which is going to be the discount we're going to be using, and I'll get to that in a minute. All franchisees to date have opened their locations at the scheduled time, and none have defaulted on any of the notes receivable. So that's, kind of in a discussion. So in a nutshell, what are the alternatives? So I would probably say that once it's opened, I would feel pretty comfortable with recognizing the $20,000. However, I would not want to recognize the remaining $20,000 per year for the next 5 years until I actually receive the funds. And as I go through here, and it's really providing that expert advice, because again, I do not know how significant this is, but given the way that this is written, if it's significant, I would probably say, yeah, that basically that $20,000 per year in terms of the franchisee, it's going to be something I want to take a look at and recognize each year because I still have that performance obligation. Okay, so the franchise agreement is signed on January 5th, 2020. Okay, so right over here, it's supposed to be annual. Excuse me. Okay. So right over here, prepare the journal entry to record the franchise fees, including the franchise agreement is signed on January 5th, 2020. So my date. Okay. So my date here is 1/1/20, or say 1/5/20. Okay, I'm going to be receiving cash. My cash amount here is going to be $20,000. Okay, I am also going to be having over here a note receivable. Okay, so I have a note receivable for $100,000. Okay, now my challenge here with the note receivable is this the proper amount to reflect as the note receivable? Well, if it was all going to be paid to me within like immediately, right, or within a few months, probably is going to be okay, but this is a little bit different. This is a 0 interest bearing note with a $20,000 payment at each of the end of the 5 subsequent years. So we're going to take a little detour here into present value land. So if I'm given something that has a 0 interest bearing note, what I have to go through and do is I have to impute interest, right? Because this 100,000 isn't really 100,000. So what I'm going to have to do is I'm going to have to discount that note appropriately to get to, you know, the amount that really should be that note receivable, the net note receivable, add that to the cash to get to the revenue. If I was going to do this really simply without showing you anything over here, basically my discount amount would be the 100,000, the face value, and the present value of 5 annual receipts of $20,000 each discounted 10% is $75,816. So my discount on notes payable is going to be $24,184, okay? And the rest of this amount here would be my unearned revenue, okay? So again, when I'm going through and doing this, right, and this would be to record the initial franchise fee, okay? This seems way too simple, right? And the reality of this here is that I don't really want you, I'm not going to give you the numbers like that. Rather, what I would want you to go through and do is how are we coming up with this present value here of $75,816? Why is this the same amount over here as this $20,000 per year over 5 years? So when I look at the concept of present value, okay, so we'll say here year one, or this will basically be 2021, 2022, 2023, 2024, and then 2025. In 2020, I've been paid this cash, right? So this is really not the issue. I should say this is 2020, 2021, 2022, 2023, and this will be 2024. At the end of the first year, I'm going to be paid $20,000, okay? And so as I'm looking at this here right now, and why can't I just show this as $20,000? And this is really going to be on December 31st, 2020, 2021, 2022, and then 2023, 2024. So I'm getting $20,000 in each of these years right here. Now, why can I call this amount here 20? Why can I call this? Why can I say, well, this is 20 grand? I'm getting this in a year from now or at the end of this year. Why can't I say that this is the same as this? And this is the whole concept of what we call the time value of money. That a dollar today is not the same as a dollar tomorrow. So because this question right here, in terms of going through, and because it's a zero interest bearing note, what I have to go through and do is I have to go through and impute interest. There are two different ways I can impute interest. And again, I can't remember for my students, it's again, if you've gone through and done bonds with the present value tables, there's two ways to do this, and I'll show you both ways. So what I can do is I can individually discount each one of these dollar amounts back to today. And the way I'm going to be doing this is I'm going to go to the present value of a dollar, okay? And this is going to be here, present value of a dollar. This would here would be 1 period at 10%, okay? And I go over here to the present value of a dollar. What's the difference between, there's two tables here. There's a present value of a dollar, and then there's over here, which is the present value of an annuity. Let's start over here though with the present value of a dollar. What does this mean? This means that a dollar today is not the same as a dollar tomorrow. If I'm being paid out $20,000 1 year from now, what I need to do is I need to discount that by 0.90909. And so the present value of this amount is $18,182. Okay, so what exactly does this mean? It means that over here, that if I took today on 1/1/20, if I took $18,182 I use my interest rate of 1%. The interest that I've earned on that is $1,818. So at the end of the year, this is my principal and this is my interest. Okay, so this 10% here is my interest rate. And so then I get my interest amount. So the total principal plus interest is going to be $20,000, right? So present valuing helps me take these future dollar amounts, and this is at the end of the year, and bring it into today's dollars. I can't just show a note receivable without showing a discount. So again, we're trying to figure out here, what is this $100,000 that's being paid in the future? What is this worth in today's dollars? So we'll keep on going with this. Present value of $1. And this is going to be 2 periods at 10%. I'm going to go right over here. And at 10 periods at 2% is 0.82645. This is going to be present value of $1, 3 periods at 10%. This here is going to be 3 periods at 10% is 0.75131. I have present value of $1, 4 periods at 10%. Over here, this will be 4 periods at 10%, and it's going to be 0.68301. And then lastly, I'm going to have present value of $1, 5 periods, because it's being paid to me 5 years from now at 10%. And this over here is going to be 5 periods at 10%, it's 0.62092. So when I go through and I multiply each of these values here by the present value factor, and again, this is the present value of $1, and this is for lump sums. Okay, and so right over here, this is my chapter 6 lesson for everybody. Good stuff. Okay, so right over here, I've gone through and I've multiplied this through. And again, how do I know that this is kind of like on the right track? Well, if I invested here 15,000 on 1/1/20, if I invested 15,026 using this 10% interest rate, I now have basically my interest is 1503 at basically 12/31/20 is my interest. So my new balance on 1/1/21 is going to be that principal plus my interest. Then over here, my interest rate again is 10%. So my interest basically for 2021 is going to be here at 1,653. Okay, so then my principal plus my interest on 1/1/22 is going to be 18,182. And now I think you're kind of seeing where we're going. I use this 10%. My interest for 12/31/22 is going to be this amount here of 1818. And so the amount that I'm being paid here in year 3 is 2020. So $20,000. What is this worth in today's dollars, or on January 5th, 2020? This is going to be worth $15,026. So when I take all these 5 present value items, right, and I go through and I add these up, my total amount here is going to be the sum of each of these, and I'm going to get 75,816. Why does that number look so familiar? Because this is what the book gave us over here. Okay, so this is how they're coming up with this number, and this is one way of going through and calculating it. This is if I look at every single dollar amount as a separate item at the end of each of 5 years. However, if any of you have had me for Accounting 1A, and if you've done these types of questions before, what you'll realize is say, hey, Tchaikovsky, you're an idiot. I don't have to use the present value of $1. Rather, because this is an annuity or the payment is exactly the same over a period of 5 years, right? What's going to end up happening is I can say, oh, okay, I don't have to go through this whole calculation here. I can say the amount of the annuity payment is $20,000. Then what I can do is I can go to the present value of an ordinary annuity of $1, and this would be 5 periods, or the number of times that this $20,000 is being paid. This would be 5 periods at 10%. So when I go back over here to look at this table, and this is, I go to the present value of an ordinary annuity. I'm going to go to 5 periods at 10%, and I come up with 3.79079. So it's 3.79079. And when I take this right here, so the present value basically of this amount is going to be 75,816. Wow, is it magic? No, it's this present value tables. And this only works because this is the same dollar amount. So if these payments, if this 100,000 is really worth, right, 75,816, and this here is the dollar value of basically the present value of the future payments as of 1/1/20. Okay, so when I look at this right here, it's not worth 100 grand, right? This is what it says on the note, right? But right over here, what this is really worth here is 75,816. So the amount of my discount, or to reflect the 75,816, is going to be 24,184. What this is really telling me, though, that even though this is 0 interest bearing, right? Oh, it's free interest. Nothing is ever free, okay? So even though it might say it's free, nothing is ever free. So if it's 0 interest bearing, I still have to impute interest. And what is going to happen is that every single year, I'm going to be, as I'm recognizing the revenue from the franchise fee, I'm going to be going through and amortizing this discount, and we'll see how that works. So my balancing entry here is going to be to unearned revenue. And the amount of unearned revenue I'm going to be going through and recording is going to be right here. It's going to be 120,000 less 24,184, or 95,816. How do I know this is right? I don't. I'm going to go ahead and add up my debits. I add up my credits, and everything's balanced for the moment. Okay, so this is how I would go through and record the initial franchise fee. Very important, right? The book here is giving you this amount. I may not give that to you on the exam. I may give you a present value table, but it's important that you understand how this is calculated. So the franchise agreement is signed on January 5th, right? So that's what we're doing here. Amigos completes the franchise startup task, and the franchise opens on July 1st, 2020. So on July 1st, 2020, right, I have gone through here and they've opened. Okay, so now what I want to consider doing here is that on July 1st, 2020, what I can do at this point is I can say, okay, they're not making the annual cash payment to me yet, right? They're going to be paying this at the end of each of the next 5 subsequent years, but they did pay me this cash. So what I'm going to do, or what I'm going to be considering doing, is that on July 1st, 2020, I'm going to be debiting, I'm going to be crediting revenue, and then I'm going to be debiting unearned revenue, okay? And this is also called in your book unearned franchise revenue. Okay, so this is unearned franchise revenue, and this over here would be franchise revenue. Okay, again, I would be okay with unearned revenue and revenue. It just depends on the situation. So I'm going to debit this here and then credit this here for $20,000. Part of the reason why I feel comfortable with recognizing this, and this is here to record, to recognize revenue as a result of the store opening. Okay, and part of the reason why I kind of feel comfortable with going through and recognizing some of this revenue at this point in time is because, well, all franchisees to date have opened up their locations at the scheduled time and none have defaulted. So what that kind of tells me is that there's a little bit of an operating history here. Now, if we were in a situation where that wasn't the case, I might want to be careful in terms of how I'm going through and recording this, right? So again, it's one of those things you have to kind of look at the particular situation. Okay, so now the next thing we're going to go through and do here is that here, Amigos completes the franchise, opens on July 1st. And then over here, the franchisee records $260,000 in sales in the first 6 months and remits the annual franchise fee on December 31st. So these are two different things. They recorded $260,000 in sales. So right here, because of these sales, I'm getting paid 2% of sales. Okay, so I'm getting my money right off the top. So right here on 12/31/20, okay, right here, I'm going to be receiving cash, and this will be over here would be franchise revenue. Okay, and this right here is going to be the 260,000 of sales times 2%, or 5,200 on both of these sides right over here. Okay, so to record franchise fees from franchisees' sales. Okay, so that's the first part. Now, the second part here is I'm receiving, right? I'm also getting here on basically at the end of the year is I'm also getting cash of $20,000. Okay. So the one part of this though here too is that when I'm looking here, so they're paying off this note receivable. Okay, so we're going to have really two different parts in terms of going through and recording this. We've got two things we need to do, okay, with regards to this, basically with regards to this next part. So that part is a sale, which is relatively straightforward. So that's the sale. This is part one. The second thing we need to do is we need to show the amount of franchise revenue that we are actually earning during the period. So this franchise revenue is something we're going to be going through and doing over a period of 5 years. So when I look at this right here, is I've got here unearned franchise revenue. And this is here is going to be 95,816 divided by 5, or $19,163.20 of franchise revenue per year. However, in our case right here for this particular question, one of the issues I have is that, well, was this open for the full year as of December 31st, 2020? And the answer is no, it was not open during the full year. It was only open since July 1st. So this is going to be for the full year. Basically for the 6 months, what I'm going to need to do is I'm going to need to take this 19,163 times 6/12, or 7/120 to 12/31/20. Okay. And this here is going to be giving me $9,582 as the amount of the franchise revenue I'm going to be going through and recognizing. So this is going to be franchise revenue recognized for the year ended 12/31/20. Okay. So those are two different parts of this here. The next thing I need to go through and do, so I've got to recognize that unearned revenue, right? The next thing I need to go through and do is I'm getting $20,000 in terms of the note payable, right? The company is actually going through and they're cutting me a check for $20,000. So I'm going to be getting cash basically over here for $20,000. Okay. Now, at the same time, I'm also going to be crediting notes receivable. And I'm going to be crediting notes receivable for the $20,000. Now, if I were to look at my balance sheet, I would be showing over here, it's like, oh, prepayment. So prepayment, I had 100,000, which is my note receivable, less my discount of 24,184. So my notes receivable net is going to be 75,816. What I need to do with this discount is I need to amortize it essentially to interest revenue, because that's really what it is. This is like interest. Basically, this is like a financing transaction disguised. This discount really represents interest revenue. So what I need to do is I'm going to take 75,816. I'm going to multiply this over here by 10%. And so over here, I'm going to get 7,582. I'm going to debit my discount on notes receivable for 7,582. And then I'm also going to be crediting interest revenue for 7,582. And this here is to recognize the interest and payments received on the note. Okay, so one of the things you might be asking yourself is, hey, Tchaikovsky, like this discount on notes receivable, why are you not using a fractional period? Well, this note receivable, the obligation really began here on January 5th, 2020, right? That's when the franchisee signed it, okay? So that's when they got into that obligation, is right here. The franchise revenue, or that portion of it, here I'm just using for the partial period, because in this for this problem is that when the store was open on July 1st, that's when I started going through and recognizing the revenue as it relates to that particular item. So what I want to do with you right now is let's make up something here for 2021. And we're going to say here for 2021, the franchisee had $800,000 in sales and made their annual franchise payments on 12/31/21. Okay, how would I go through and handle this? Okay, the first thing I'm going to do is I'm going to show, essentially it's going to be the cash coming through as a result of basically from the franchisee's sales. So here, this is going to be 800,000 times 2%. And I'm just making this up because it's fun. And here is going to be to record the franchisee's fees from the franchisee's sales. And this is going to be on 12/31/21. Now, over here, what I'm going to go through and do is I'm now going to kind of go through in here and saying, okay, what about the franchise revenue? Well, unlike the other one right here with this franchise revenue is that, well, the amount that I'm going to be recording for the full year ended 12/31. So my franchise revenue recognized for the year ended 12/31/21 is now going to be a full year, or 95,816, right? Divided by 5. And I'm going to go ahead and this is basically going to multiply this by 12/12. So my earned franchise revenue is going to be over here at 19,163. So now let's get down to the fun part. Okay, the fun part is this last part over here with regards to the note receivable. Well, the actual format of the journal entry is not really going to change. Okay, so however though, so this cash, I'm still getting 20,000. I'm still going to be crediting notes receivable for 20,000. However, my discount now is going to be a little bit different. My discount on notes receivable is a contra asset account. And that discount on notes receivable right over here had an initial balance on 1/5/20 of 24,184. Okay, so over here on 12/31/20, I amortize this by 7,582. So at the end of the day, at the end of December 31st, 2020, my unamortized discount is going to be right here. Yikes. Okay. This is not working out for me. So let's change this here. There you go. And this here will be 24,184. Subtract the smaller from the larger, I get 16,602. And this here is going to be at, this is my ending balance here on notes receivable. So when I'm looking at this notes receivable for the current accounting period, right, my amount of my note, okay, so, and then when if you look, this is my discount, excuse me, my notes receivable, and this is going to be on right over here. So I had a notes receivable of, so this is on 1/5/20, this is 100,000. And then I had 20,000 on a payment on 12/31/20. So my ending balance here for my note receivable is going to be $80,000. So my ending balance here is 80 grand. So when I go to do the interest computation right over here for my interest revenue, what I need to do is I need to take, so my note receivable is 80,000. My discount amount is 16,602. So my notes receivable net is going to be 63,398. That's the current carrying value of my note receivable. So I'm going to multiply this by the interest rate of 10%. So my interest revenue for 2021 is going to be 6,340. So right over here, I've got 6,340. And that's what I'm going to keep on doing. And so what I want to do with you right now is just to kind of take this, basically this payment here through all the way to the end. Why do I want to do that? Because it's fun. And I love rambling YouTube videos. I'm violating every single principle, so I need to keep on doing it. So let's go ahead and just focus on this one here. Again, I'm not going to do the rest of it. Let's just focus on this here in terms of what happens year after year. So that was 2021. What is 2022 going to be looking like? Okay. So for 2022, okay, so this is as of 12/31/21, okay. So what happened here then on basically, I should say here, so what ended up happening here, so this was 12/31/20, 12/31/21, there was another $20,000 that was paid. So when I look at this here, what I'm going to be doing here, my new balance in notes receivable over here is going to be an ending balance here of $60,000. On my discount on notes receivable, I amortized the discount on 12/31/21 by $6,340. Okay, so right over here. So my ending balance now on my discount on notes receivable is going to be $10,262. So my notes receivable had a face value of $60,000. My discount on notes receivable was $10,262. So my notes receivable net was $49,738. So my interest revenue in 2022, which is going to be year 3, is going to be $4,974. Okay. Now, just kind of going through in terms of what would happen next year. Well, my note receivable was at 60. I'm going to amortize, or I basically paid down another 20,000. For my discount, I had another 4,974 over here. So, wow. Okay. So my ending balance over here on my discount for the following year is now going to be 5,288. So when I add these two amounts up, I get 34,712. My interest revenue is going to be 3,471. In 2024, the amount here is going to be 20,000 because I just paid another 20,000 off. Okay, my amount of my discount is going to be 5,288 less 3,471, or right over here at 1,817. Okay, so my notes receivable net is 18,183. And when I do this, if I know I've done this correctly, my interest revenue is 1818. So when I go through and amortize this, my discount now is going to go down to 0, which is where I want it to go once that loan is fully paid off. So again, this is what would ultimately happen with this. I didn't do the other parts, which are going through and recording the amount of the sale every single year, as well as the unearned franchise revenue. But in order to go through and do that, I would just have to give you those numbers. This is going to be the same for every single year, except you're going to have some trail into 2025. Because again, in 2025, beyond 2024, is because you're going to have some residual amounts that you still, because the note will be fully paid off by the end of 2024. But since you actually started the franchise on July 1st, 2020, then that's what happens there. So you're going to have another 6 months after 2024. Okay, that was a lot. But again, what's so important for you to understand in the terms of this particular question is that when you have a note receivable with zero interest bearing, which is zero interest bearing, basically the FASB and the SEC says no. And I call that bull, you know what? But we can't do that, right? You can't go through and just say, oh, it's 100,000. No, you have to impute interest. And we do that by doing the present value. We're going to take basically that annuity amount, multiply it by the factor to get to the present value amount. That difference becomes that discount on notes receivable. Okay, so the last one here is briefly discuss the accounting for unearned franchise fees, assuming that Amigos has little or no involvement with the franchise related to expert advice on employee and management training, quality control, and promotion once the franchise opens. What you would say here is that this part here is de minimis. That's what this part C is showing here. So in this case, what we would be doing is, as soon as the franchise opened, I'd recognize this $95,816 as well as revenue, right? I'm still not going to get paid, but it would be something I would be going through and recognizing as revenue. Now, I want to caution you, okay, is that if you're pulling this all into revenue, it really is kind of tied in with this note. So if you are selling a franchise and it's kind of dicey, right? Like you don't know what stage you're in. Are you in an early stage environment? Are you in a late stage environment? Then you would want to be more conservative and probably recognize that franchise revenue, or that basically, or the recognizing the unearned as they're going through and paying down on the note. But again, it just depends on the particular situation. So that is exercise 1812. I don't even know how long I spent doing this particular question, but it's a long time. But it's a very, very good and very, very important comprehensive problem that goes through revenue recognition. I cannot tell you how important it is to understand revenue recognition, and this problem does a pretty decent job of going through and doing it, especially from the financing side. So again, I want to thank you for joining me tonight, or today, or whatever time you might be in. And don't forget to like and subscribe to these unlisted videos, and I'll see you on the next video. Have a great one.